Trading the foreign exchange market carries high risk and may not be suitable for all investors. Trading on margin, utilizing leverage can carry an even higher level of risk that can lead to a complete loss of investment funds. So before deciding to trade the foreign exchange market or using any of our software alert products, you should carefully and diligently consider your personal investment objectives, level of experience, and risk tolerance. There is a possibility that you could potentially sustain significant loss. You should not invest any capital or trade that you cannot afford to lose. It is your responsibility to be aware of and understand all risks associated with foreign exchange trading and to seek professional advice from an independent certified financial advisor if you have any doubts. Auvoria Prime does not exercise trading authority over your trades. You and you alone exercise discretionary trading authority over every trade.
Welcome all Auvoria subscribers to the Trade Week Forecast Call. Today is the 11th of September. My name is Steve Vetterl. I'm your CMA, also serves my role as your mentor on the risk management side of the equation. So since we are new to the platform here in AP Live, which is awesome, it's actually much easier to load up, so forth. Let's make sure you guys can hear me okay, and that I am sharing my screen, which you should see the Forex Factory calendar. So you can always go into the public chat, type anything up you want, keep it clean and for the love of the group. So going into just the weekly here, actually, you know what? Let me just pause real quick. So for those of you just joining us, my name is Steve Vetterl. Today's the 11th of September. As we do take a quick pause for all of the lives lost on 9/11 in New York and the terrorist attacks that hit our country. So my thanks and the appreciation goes out to all of our first responders as well as those that have suffered a loss. We are on the Forex Factory calendar next week, September 12th through the 18th. Let's take a quick look at the calendar. And so Monday being the 13th. Right. So looking at Monday, we got central bank discussions here, so just be aware of that. I think the big one Tuesday, if you take a look at core CPI in the center here, we've had a lot of forecasts that were wherever they were positioned, but the actual numbers came in higher. So if you're wondering why this transitory inflation, sort of this new tagline in the marketplace, it's because of what we're seeing here. And in many cases, these echo the numbers we're seeing globally as well. So the important thing to understand is that we got to take a look at the actual on Tuesday. So it certainly argues for a tapering. You know, there's been some news in central bank land here in the U.S. of some of the Fed governors having some issues with stock trading in their own personal accounts and, you know, sort of breaking away from our leader, Jerome Powell, at least as far as the central bank's concerns, pushing the transitory discussion away. So we want to keep a close eye on this. Certainly from an equity standpoint, we started to see a little bit of a rollover Friday, which I'm not going to get too much into today, but I think it's important to just understand this could be affecting currency land, already has in some cases, as I'll elaborate. So on Wednesday, anything AUD, NZD, CAD, you know, keep in mind a lot of the developers have had their CAD-based pairs either paused or turned off because of heightened volatility. Quite frankly, they just haven't been acting very well. So, which happens. So when you want to do that, again, it's a risk issue. You want to turn it off, or at the very least limit a very super conservative settings on those pairs if you want to be involved in them. Thursday, we've got retail sales, so forth. So there's the, I'll take a snapshot of this and actually put this calendar in the AP Live room. I don't know if you guys have had much of an opportunity to get in the room, but I would highly suggest we have, as far as this recording and participation, a much lower turnout. I think probably some of the issues people had getting in the room, because I was live for at least 3 or 4 minutes and nobody showed up. So as we get all, so I just paused everything, and, you know, I'll continue to make sure that I'm only talking when people are actually in the room. So even though the recording, I'll just pause it and we can edit out any issues in the beginning, get that loaded up. So as we continue to iron out all the AP Live stuff, which has been moving quite well, and it's been very smooth for me. I really haven't had any issues. So I kind of like it. I mean, it's easier. You don't have to log into all these super secret passwords, and you don't have to post everything. It just can all be done right on the platform. So if you haven't checked it out, please do. All right, let's go into. Actually, I'm going to do a quick FinViz. So this was Friday, and I'm only showing this on a 5-minute chart, which I certainly could do, I guess, on an hourly. It's just to illustrate this drop at the end, okay? So for those of you trading equities in the U.S. or trading any MT4-based algos, either in more of an automated version or just accepting trades, just know that could be a volatile open on Monday just based on this sort of rug pull, if you will, which a lot of times can happen on a Friday afternoon when volumes start to pick up. Crazier stuff takes place. I expect much crazier stuff to be taking place over the next couple of months as a lot of institutions globally start rebalancing their books in anticipation for a fiscal year end, which many mutual funds, at least the US-based ones that I've come across, probably 3/4 of them have a calendar, not a calendar-based year-end fiscal, but October 31st. So, which seems kind of strange, but I've never been able to figure that out myself. Probably a reason for it. What else I want to say? So let's go to everything, and then you just click on charts, move to daily as we see here. It's a little bit of a rollover in the exchanges. Keep that in mind. This is really the one that, I've got to believe that the reason I keep talking about this is going to spill over into the yen at some point. But man, the Japanese equity market's just been moving up. Shocking, really. And then again, it's been in the toilet for 30 years, so I guess we should expect something different occasionally, right? All right, so I'm not going to touch too much into commodities, but I did want to address the metal space. With a declining dollar, it typically is completely inverse or uncorrelated in terms of its move, meaning that if the dollar goes down, typically metals go up. All right, so if we continue to see a declining dollar, do keep in mind for those trading gold. You can see what's going on in bond land. This is the U.S. bonds. And then obviously the dollar, this is a daily chart, by the way. Each of these candles represents a single day. Dollar coming back and other markets lifting in relation to that that have been slight trends up as we've been in a broader trend down, even though we had a little bit of a reprieve and then some more of the volatility in the Canadian market. Again, so as the dollars move down, you've seen most of the pairs on the opposite side of that in a movement up pattern. So just keep that in mind and then we'll move into discussions on those. I've spoken between about 93.50 and 94, 94 and a half-ish is really the big resistance on a longer term chart, which isn't necessarily easiest to see on the high side here other than my dotted line that I'm highlighting here at 95 and a half, but down to 94 and a half, or I should say down to 93 and a half has been the whole zone and has not been able to get past since August, essentially a year ago. So we've tried a number of times, and typical technical analysis theory will tell you that if we've tried a number of times and we haven't been able to break, we probably need to move lower, right? So that's certainly the argument I'm posing. I certainly could be wrong, but at the same time, just looking at it from a pure technical analysis standpoint, any monetary policy changes or changes in policy in with all the idiots in DC in our country could certainly put an end to that goal. But ideally, if you look at the weekly chart on the dollar, as I've talked about, it's just getting ridiculously, I sound like a broken record. This whole 89 area is the edge of the cliff. And if we do get under that, you're probably going to see a zipper based or really protracted move right down to 85. I think we'll probably stop somewhere right in the 85 area, which is where my dotted line is right now. So, moral of the story is if in fact that does come true, and the beauty of that is that I am in the minority camp with that longer term move forecast. So a lot of the institutions out there are positioned for something else to happen. And typically you want to be in the minority camp because it's not already priced into the market, like I think a rally is right now. Again, you always look for places where you can be wrong. But so we break 89. I really would not, anything that's attached to the dollar that these EAs are trading or shooting you off notifications for the trades, I just wouldn't be accepting any shorts, right? So if it's Euro USD or any of the other pairs associated with dollar, we break this level, you're going to want to see me personally want to be long most of those other currencies, right? Not accepting any shorts unless we get really extended, right? So just keep that in mind. It's always more difficult from an accepting trade standpoint versus just an EA trading it all for you, because you're really, the problem with that is that I've made these comments a few times over the last year, and I've generally been right as far as sidestepping a train wreck. But the problem with that is statistically I have much chances of being wrong down the road, right? So just looking at basic statistics. So just looking forward, but the win rate on a trade is very high if you're riding the coattails of the caboose, as I've often talked about, and not stepping in front of the train, okay? Unless those moves are so far outside of a normal rubber band stretch, whichever analysis tool you're using for that, like a Kellner's channel or Bollinger bands. These cases are Bollinger bands that have a custom build on them. But we come up against those. You can often see times like that. These things have been really accurate where we're touching the bands, it's really stretched and it'll come back, right? So that's the only time I'll step in front of the freight train in a just a ridiculous move of some sort, right? I've talked a ton about examples where I show that in the past, but ideally the reason that the vast majority of quality mentors and educators, and that's a small list because most of those guys are snake oil salespeople, they want you to trade with the trend, and it's for a reason. It's because win rates are higher if you're just moving within the trend, right? It's almost like a self-fulfilling prophecy that comes to place. But just looking at that, we break below this area in my long diatribe here. I just would not want to be long the dollar. I'd want to be short the dollar and long anything it's attached to in a pair. So the Euro USD, opposite side of that, you can take everything I just said and flip it completely upside down above this 25-ish area. I want to be long. In the initial moves, not the whole way, right? Because then this is where it's a slippery slope of me saying, oh, well, Steve's telling us to step in front of the software. And I'm like, nope. I'm just saying for the first break out of a major consolidation, which I would absolutely position this move to be over the last year, our first break from this major consolidation. Who knows? It may not even happen this year, right? I could be completely early in trying to have this discussion, but it's a risk management subject that's very easy to teach. It's very easy, in my opinion, to conceptualize because you're using long-term levels to figure it out. And again, platform's new, but feel free to ask questions in the public chat, okay, as we're sort of ironing out this whole platform thing. Let's try and give you a bigger viewing area here. All right, so everything I said, just flip it upside down for that one. GBP, again, that consolidation since we broke down into these lower levels. Notice we're looking at weekly charts still. I want to see the bigger move, right? So it's been a long time since we've been in this area. We broke down into this lower zone, which is a big old zone I could just draw a box around. And right around the middle of 2016. And, this zone's a big area, and we're, again, right up against it. Why? Because the dollar now is right up essentially within $2, a little more than $2 away from that area. This actually looks like it's coiling, at least from a weekly perspective, but we do have a fairly solid ceiling on this move. And it is, quite far away, but just understand we're sort of balancing in between these areas. Any break from these areas, especially up here, absolutely you want to be along the break. At least many days of the first few days that it breaks, right? Because there's tons of stops up here, long-term stuff that probably big institutions that, at least in their opinion, are okay with having huge stops on positions up there. I consider that to be sitting duck type stuff. That's why I would never have, even if I had a huge position, I would never have, provided I had enough traders covering the desks all the time. But I would never put myself out there as a sitting duck if I was an institution. So if I was like a JP Morgan or a Barclays, and I had some multi-million-dollar long position, or I should say short position in the pound, to have all those stops just sitting out there, sitting ducks, because the algos are going to see them and they're going to go after them. So there's plenty of what's called stop hunting algos out there that'll just go up and terrorize these pockets. It exists in almost anything that's traded in a very highly liquid market: futures, equities, commodities, in many cases, certainly oil. So keep that in mind. USD CAD. Now, notice I've been focusing a lot on weekly charts. I usually focus mostly on daily. Actually, let me just quick snapshot of the daily on this. Yeah, I will touch on GBP CAD. Always do. Actually, go to that next since we're GBP USD, because I always really think that those CAD discussions, or at least the GBP CAD, needs to be addressed right after you focus on these two, right? So I sort of like that pin action, talk a lot about. This is the center pin, second pin, right? Third pin in that particular cross, if you will. And then you move to GBP CAD next. So I'll go through that. But that's the order of analysis that I do if like, let's say I had big positions in a number of different NEO settings, right? Mode 1 and or mode 2. These are the currency analysis that I would go through, each day, each week, in order to know where to be either accepting trades or comfortable that NEO's taken the right position, right? So US GBP USD on a daily chart, it's not much difference. That same coiling, you've got pretty decent floor here with a lot of these yellow lines, and a pretty decent ceiling here. We're tightening up. Now we're in a real small coiling. We certainly could break from that and go a little higher, would be my anticipation with the dollar going down, unless some of those CPI reports here in the U.S. on Tuesday are a real issue. I think we need to be sort of extra eyes wide open in this for that Tuesday report. Also, do keep in mind with a lot of those is always check the times for your local Forex factory, to your time zone, wherever it is in the world. Don't look at mine. Okay, I've had a couple of subscribers say, hey, they didn't see the news came out and they weren't aligning the times up with their own current Forex. So just make sure you do that. All right, so let's move to USD CAD. This is a little bit more murky. This is one of those ones where it's been in an uptrend as the dollar's been in a downtrend, but it's been real volatile recently. Partially because of what the Canadian bank's doing, partially because of some of the numbers that are coming out. Keep in mind, this is a fantastic country from a traveling standpoint. They have a tremendous amount of natural resources, some of the best in the world, in a much broader sense than just oil, right? So as we've seen some volatility in commodities, a lot of lumber, keep in mind, comes out of Canada as well. So but we've been coiling and hell, I don't know where this is going to go. I really don't. So just be aware, and this is why some of the pairs have been turned off. Now, if we take a look at GBP CAD next daily chart, this is a little different. So now, 1, 2, this is the fifth, arguably the fifth time we've come up against this area. And this area is 75, 70-ish, right? Down to 75, 70. Okay, so this whole zone, if you will, this is it. So I guarantee you there are stops up there. I don't personally, again, I'm not smarter than Neo. I just am saying that, we've come up against this area a bunch. There is a much higher probability now that we're going to break above this. I would not want to be short this when we break above it, right? Not in the first candle, right? Because we've had enough just rips right into this area and just had complete rejection, right? 4 times before tomorrow. What's that? Tomorrow. 4 times before, well, I should say tomorrow night, right? Into Monday. But it's been completely rejected each time. So now you have to ask yourself the question, is there an institution or a group of globally that is willing to step outside of the box? Remember, that's the definition of an other time frame player, right? Meaning they don't care about this. They're willing to take it higher because they're playing in some other time frame. We don't know what it is. We don't know what the institutions are, but who cares? The point is it can be completely illustrated in the volume that prints, the order flow that follows, and more importantly, what this actual price action does on these candles charts as far as our technical analysis, right? So it breaks above this line and it holds for a day. It'd be the first time since when? Early March of 21, right? So if you're the software, and again, it's just trying to have you guys think like an algo, think like, just sort of like a bot in how you should be executing. Now we're breaking. You gotta believe, especially in these last 2 times, I would think, and common sense in order flow land would say, well, we've had 2 rejections. Is there a bunch of stops piling up in this area? My answer is yes, and it probably is one of the biggest, right? Unless these, and this typically is the case. So we break above this, and obviously keep in mind this is a pin action currency. There's a bunch of other shit has to happen in front of this, right? So, but it breaks above this area, and then it just starts to move in what's called a zipper, which could take it all the way up to the 70s whole zone. I would say the edge of the zone is probably the 777 area. Yeah, so somewhere in 7.7, sort of the area would think it would want to go to. And on its trip up there, again, we have no idea how long. I don't know that I'd want to be short. Okay. Normally, and probably more than likely all the time, the software's smarter than me. But that's one of those times I just will step in front of the software. So take that direction for what you will. Okay. Also want to say in Neoland. And I've had conversations with Fernando and the team on this. And I can't seem to, and look, I understand it's proprietary. They're not going to give away the farm to me just in some discussion, even as much as I try to bait them. But, you know, I would have some sort of fail-safe, just because statistically, if we're going to talk just about win rates in breaks, and again, this is a daily chart, right? If this was weekly, this would be even more powerful, right? But if we're having just a basic discussion as simple as it can be on win rates, this is one of the best win rates in all of trading in any type of trade situation. It breaks the daily. It's come up against it a bunch of times, right? Remember, this could be the exact opposite on the lower side. More than likely, stops are piling up, right? All these birds sitting out there waiting to be shot, so to speak. We call it a barbecue. And then it's just going to zipper it up into the next area. Quick move through this. I want to ride the coattails of it. I don't want to be stepping in front of the freight train of it. Now, one of the times, you know, let's say this move real quick, like in a day or so, which would be a pretty big move, by the way, but wouldn't be surprised. I actually wouldn't have a problem. So if I was manually trading, forget about Neo for a second, just say you're manually trading. You know, you want to be long this move, at least for a couple of days. There could be huge pullbacks, and who knows? You know, it could get a bunch of rejections and fall back down inside of this trending sideways, what I call auctioning from high to low, right? Just a balance type of position. We're in a tight zone, but you know, we spend a day and close above this candle, I think it's going to run, and I want to be long, not short. So don't really get much of an opportunity. I think probably about 3 or 4 times over the last year to discuss much more clear technical analysis views, if you will, on a potential break higher. The problem with this is that there's a whole bunch of other currencies in the way of this and other pairs that kind of need to fall in place in order for that to happen, right? And that's the difficult part that's hard to teach. And quite frankly, I could have a terrible read on this, and it could go right up to this area and back down. But statistically, and I don't care what market it is, on higher time frames, right? Daily, weekly, certainly monthly, we come up against these areas, and then we break and hold above them. All the freaking bells and whistles go off on all these algos, right? And then everybody's like, "Oh man, what the hell do we do now?" You know, and then a lot of times it's just going to go up and just barbecue everybody. The short blast out, clear out the complete queue of orders that are sitting on the dome, right? And then just reverse. This just happens all the time. It's crazy. So if you can envision that, right? So I always say that the smartest people out there may not always be right, and I can certainly be wrong and be a complete dummy the next quarter in a lot of these prognostications as well, right? But I'm just going off of historical stats. Anyway. US 30. Let's talk a little bit about that, because I'm not going to get in a lot of these other currencies today. I have limited time. Did want to look at gold. Let's make sure we're on the daily here. Still inside that range I've talked about. At the bottom of this 1,600 an ounce is sort of the floor. Look at spot. It's maybe a little bit clearer. But this whole 1675 area is the absolute floor. It's been completely rejected off that. We're more than likely going to break this, especially if that dollar continues down. It's a big area of resistance, and the exact same thing I just taught for the last 10 minutes is the case here. So if you're trading this, be aware that we could have an absolute break, and it just could zipper up into this 1900 an ounce area. What else? VIX. Notice it's creeping up a little bit, guys, so pay attention to this volatility index here. All right, what else? So US 30, okay? Everybody know what that is, one for one, because I know a lot of people are essentially the Dow Jones, okay? I hate the Dow. I don't really show it a lot. I never show it to clients, right? Why? Because it's an inefficient benchmark. It's a price-weighted, not a capitalization-weighted index among 30 of the biggest companies in this country, right? Intel, Microsoft, you know, all the big names out there. Procter and Gamble, right? So with all the in the UK. That's kind of like a Unilever here in the US. But we are on the edge of support, and this came late Friday, right? So we break this and hold. In this case, I'd actually be dropping down to a 4-hour chart, right? We break this and hold for a 4-hour candle, you're probably going to see a lot lower. Why? It's the exact same thing I just taught. I've had a period of time, pretty decent period of time actually, all the way since end of July. We've been in this upper zone of this whole upper balance area, and now we're about to break it, right? Arguably on a 4-hour, you already said we broke it, but pay attention to the dailies. Those ones are going to require expansion out here. Let me show you. Right? Close below this on a daily candle, we're going down to the next area. In which case, more than likely, I'm going to need to have the zones up. But I don't have the volume overlaid on this, so I don't have my market profile blue lines like you normally see. But you know, you can actually almost get better analysis, in my opinion, over just analyzing the spiders. Okay. Now, they don't have as clear of a situation as the D30 does, but you'd want to just look at just the balance area, this upper zone, which I guess really would be just, and they've actually added in here the ability to start the chart from a date. So 2nd of August, is that right? Why did I just do that? Get that date right. Shoot. Still, it's not drawing data from there. You just want the recent data. Because then I could put the volume analysis in this US 30. I'm a bit wonky out here, so. I guess that's kind of close enough, right? The support line is right in this 4430 area if you're following the S&P. Now this is spider, so this is an ETF trades, but essentially it's the 4430-ish area you'd be looking towards the support. But it's the first time we've come up since the 19th of August and touched a moving average line. Okay, so this is the kind of analysis I would do on US 30, even though I probably confused a bit of you, sorry, but I'm just not getting the price scale that I want on this. You actually know would probably be smart. I just thought of some moving it to a 4-hour chart so you could get back to that August, because I only want the volume data for this upper zone. This is the problem with TradingView. If we were on my IRT software, I could actually just set the date in and it would pull a volume in for this whole zone here. But this is what happens if you're looking at volume for lower zones. It's affecting the data. You only want to see what volume's executed since we've been in this upper range, right? So that's why I'm trying to cut it off around this August. Should be okay. Why do I do this? Because this is where the support is. Until this point, now arguably on the Dow 30, it's looking a little different. Like it's on the support point, it could break below it. But the key is that it's holding right here. I don't know what's going to happen on Monday. There's a lot of news swirling around this weekend, but you know, I've been warning this whole period of time that once we get out of vacation mode and everybody sort of gets back to work. So depending on where you are on the planet, the vast majority of children are already in school, if not all. So now that means vacations are everybody sort of back to work, and institutions have potentially higher volume that they're trading. For the question on crypto, I just got, here's the Bitcoinage. Look at it on a daily chart. remember, I only want to see the bigger, broader moves, right? So I just try and expand it out to what's happening. For those of you who are not really familiar with wave analysis, this whole move from head and shoulders to a break of the neckline to a lower balance to this is in, and I'm not a big wave analysis guy, but I've certainly seen there's about 2 or 3 people on the planet. One guy's name is Heinrich. You'll see me retweet a lot of his stuff on Twitter. It's actually probably one of the best Elliott guys I've ever come across. He runs a big hedge fund in Europe. This is textbook C wave down. What's that mean? That means, and I think I posted this a bunch of times, if not retweeted it, but if you haven't seen any of those posts, just go to my Twitter and you can see where I posted it. My Twitter handle is @FXES Trader. C wave down takes you down to the previous move high. So essentially, if a C wave plays out, this is pretty textbook C wave. You're looking at a 20,000 target, which is what I've been saying all along. Let's see if I'm right or wrong. This one's just difficult to know if you're going to be right. I mean, you can look at the chart patterns, you can look at the volume. Notice that just from a price action standpoint alone, if you go to a 4-hour chart, let's reset the scale. If you go to a 4-hour chart, that's always different in crypto land, but anytime you see a big move, you want to see a decent bounce, right? So the volume was huge at this area. Open up my stats. So look at the volume on this candle, right? It's a little less than 3,000 coins traded in this 4-hour candle. Look at the bounce and the volume that takes place. You know, if all these shills on Twitter and FinTwit that just constantly shill this, wouldn't the volumes be like really high? Like if I was thinking this was like a great buy area, right? This next candle's volume would be higher than this. And then it would continue to, you know, ideally form a decent pattern and break back out. That's essentially a buying pattern, right? Whatever that lower or breakout pattern is, cup of handles. I talk a lot about different ones. But look what happened. All these candles printed, and we continued to test lower, right? And you know down here, somebody or a group of institutions are defending this area, right? Because they're just going to get barbecued if we go any lower. Hey, I could be wrong. We go back up to 53. If you're long and you're getting hammered right now, I hope I'm wrong. But I'm just looking at just core technical analysis here, and look at these declining volumes. Now, obviously, there's some, you know, it's the weekend, and there's all kinds of things people will say in there to sort of make up for it. But just look at it on the surface, right? Does that look like it wants to bounce? No, looks like it wants to go lower. And this was probably some big institution or a couple of whales, or whatever the hell they call those people, just dumping, right? Consequently, if you look at the daily chart, right, you want to look for cues in other stuff, right? If you look at the daily chart, you know, we had the same drop play out, but look at the same thing, and this is just daily candles, but same thing's playing out with ETH, but it's just much higher in terms of where it's gone, right? It was just almost like Bitcoin back to the highs, right? So just, you know, when you're looking at crypto, just understand the cues that are showing up. You know, always be thinking, how could I be wrong in this scenario, right? Just sort of playing that devil's advocate against yourself, which I constantly think about, right? I always look for some pin action in Coinbase, by the way, as a great idea as to what's going on in crypto. You know, this chart doesn't look good, right? This is just a daily chart. This thing's recently gone public. Coinbase is one of the largest US-based crypto exchanges, but competition's getting fierce. You know, you saw Brady and all those idiots on the NFL on Thursday night touting FTX, right? There's another brokerage coming online, and then Robinhood, which I would never do business with, coming online. in crypto. So the competition's getting fierce, but now we think if crypto is just absolutely killing it, Coinbase be going way up, right? Just on the surface. I could talk for 2 other hours and all this other stuff, but I just wanted to address that. AUD CAD, I wanted to let you know we're almost ready to break higher on that daily. GBP NZD still haven't gone off the cliff yet, right? I think a lot of this is just the pound looking to break out. So its weakness on this chart in relation to New Zealand dollar could reverse. Don't have a lot of clarity there. Euro CAD, I guess this thing's probably ready to lift as well. I can't say that I'd be steamrolling the back of the train riding on the caboose if this thing broke higher, just because this has spent a lot of time consolidating. You notice it's going into a really odd shaped flag, if you will, or some sort of triangle. Typically when it gets very towards the tip of a flag or some sort of triangle breakout base, it's going to run out of that. Euro GBP, again, opposite side, not looking to break higher. In my opinion, was probably got more time to spend balancing in a very tight range down here. All right, let me take a look at the question. So just remember this, the question about bonds, I choose to use the iShares, which is iShares State Street Bank, one of the more solid institutions on the planet. They're in New York. They use the 20-year, right? There's a 20-year ETF and then the IEF. And I do that because, one, I don't have a feed coming in here for futures on the bond side, but I want to be able to. These are two of the most liquid ETFs on this entire planet. They trade bazillions of shares a day, so they're super liquid. Let me look. Here's 8.4 million shares in one day. So that tells you it's a liquid, accurate market to study from an ETF standpoint. I'll overlay all of my technical analysis on this. Keep in mind for the question I just got down here, this is a trending empirical suite's a trending technical indicator. I don't need to see this, but I have it up because it just shows the strength of a particular trend, right? I mean, if something's moving up, right? In this particular case, there's 4 different candles that printed one time framing higher, right? You know the trend's going to be strong, right? So I just do this so you guys can sort of follow along. Anytime you see a strong trend, you'll see, this on the either side. I do think there's a lot of noise in this empirical suite, so I try to either toggle it off or have it hidden. But just as a side note, do understand that macro piece that I've posted. It's sort of like it's a macro and micro economics course all on a single sheet of paper that I would memorize. This is actually it's a great tool. But just understand the correlation between bond prices and interest rates. It's like a seesaw, right? Bond prices are going up, the yields and interest rates are going down. Why? Because it's costing more to buy bonds, right? That pay out, if you buy $1,000 bond, it pays out $10, which is paying a 10% interest rate, right? Everybody's going to want that bond, so the price of the bonds maybe will go up to $1,030, right? So its yield, because it's still only paying out, $100 a year on that bond, but the price is now $10.30, right? So the yield is lower. Maybe it's 9.25, maybe it's 9% at that point. But that's the best way to look at the relationships between bond prices or credit and the actual yield. Hopefully that answers your question. In terms of just credit in general, credit being banks wanting to lend money to whoever globally, right? Could be institutions, retail. The actions of a central bank, let's just use them all grouped together in the aggregate. If they have, hawkish views on what's going on, and there's lots of open market operations taking place in terms of buying up of assets, the Fed's taking in assets, right? Just think about this as like a garage sale. Fed's taking in assets that are giving out cash for those assets, right? Most of that cash lands in primary dealer accounts, the 14 largest banks in the world, and then makes it into the system. That is good for credit. Why? Because it's flushing the system with flows of money, increasing M1, right, monetary supply, thus lowering typically interest rates. Now, if the Fed's out there selling assets, they're retracting cash from the global marketplace, right, in whatever form. That is a retractionary or a tightening type of mode. That is not good for credit, right? Because there's not as much cash out there floating around. So it really is that easy. I mean, if you just leave it at that and just think about that, and or you just go through a couple of pieces related to that, it's really all you need to know, in my opinion. Unless you're going to get into the world of economics, right? It goes a lot deeper than that. There's 4 or 5 levels of money supply: M1, M2, M3, and they all layer in different factors, including GDP. But really, just on the surface, just understand what helps a bullish society or a planet, and what can lead to a bearish, which essentially is the Fed out there selling assets off, selling bonds, whatever the hell that anybody's selling, right? If there's a ton of artwork being sold by Christie's or auctions and Megum and Barrett Jackson, right, all the auction houses around the world, Sotheby's, right? If there's tons of anything hitting the marketplace, tons of pictures, right? There's more supply, right? And if the demand's not there, what happens to the price of supply? Falls, right? The demand's been tightened in a lot of areas globally. Certain commodities, certainly pockets of housing in this country, I would imagine globally as well, depending on the market, probably more so in developed markets. There is disruptions in supply chains. Most of this is COVID and China virus related crap. But those cause prices to increase when supply chains disrupted, and or there is any kind of demand going up, just like housing example. I'm seeing a perfect storm of this in Florida right now, right? Many of the homes that we're looking at, these things are 150, in some cases $200,000 over what they're even worth, in my opinion, right? It's probably better we just build. But the demand is actually starting to level off for a lot of stuff, at least in Florida. I pay me more attention there than anything. Probably to a certain degree SoCal. So real estate is sitting on the market longer. It's what's called a DOM analysis, stays on the market, which realtors never want to talk about. But it's really important, right? If the DOM something's 378 days, it's been sitting on the market for a year, you have to ask yourself the question, why, right? More likely it's overpriced, and you have an owner that will not budge because they think they are God's gift to real estate pricing, right? There's tons of these people out there, right? So just move on, or make them a lowball offer, right? That's for a whole other discussion. So, don't get me wrong, I respect the real estate profession. I think they have done, at least from a risk management discussion, they have done a tremendous disservice to at least this country and all of the retail buyers of homes out there, because one, they've absolutely saturated their profession with agents. That's a problem. Number two, because a lot of them just cannibalize each other. And primarily, in realtor.com is as much to blame for this as anybody, but they always have a bullish view on prices. So if you're looking at Zillow, Redfin, or realtor.com, or whatever analysis of real estate, and this is probably the case for most websites globally, right? you never see a price decrease in any of their projected charts, right? Well, real estate's gone up for the last 10 years. But what they won't show you, if they really wanted to be objective and transparent, right? They'll show you how much house prices absolutely crashed between '07 and 10, depending on the market, depending on the where, right? SoCal, they got clobbered. They get cut in half in some cases. They won't tell you that. So always have an objective mind when you're out there buying anything, right? You know, same thing with cars. You know, you don't want to look at like Kelly's or freaking Blue Book or any of these average prices of cars. It's all BS. You want to look at what's called Black Book. You want to look at what they're going through the Manheim Auto Auction at, which is a wholesale based price. But at least you have an idea what the dealer's paying for the car, right? It's the same thing can be said for all kinds of different stuff. So, risk is always best played out when you buy low and sell high. But the human brain works in the complete opposite. So if you can at least recognize that, you know that it's a problem typically mentally among many humans. You want to try and do the opposite side of that. All right. So I've gone off my soapbox here for an hour. I'm going golfing. See if I can improve my rotten game today. So everybody have a great day, great week. Glad to see we've got some good participation on the group here. Keep spreading the word. I think we'll get a lot more people in this weekend because you guys are actually some pretty decent questions. So keep coming. Love you guys. May the trades be with you.